BP, ticker symbol BP, is currently trading at $33.95 a share. Year to date, this stock is up about 15% off some good earnings news as well. But if we look at the stock over the last year, it had highs around about $39 a share, dropped around about 25%, but has increased about 20% since that time. What I'm going to be doing today is looking at my automated stock valuation spreadsheet, seeing if BP is a buy or sell using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So let's just quickly put in the ticker BP and we can have a deeper look. If you're interested, check out my Patreon. Links are in the description. We'll talk about that more later. So BP, $33, almost $34 a share, market cap of 90 billion, PE ratio of 243, which is very, very high, much higher than the market average, which is around about 30. But they are profitable, which is good. But yes, that price to earnings ratio is very, very high. Earnings per share 14 cents and a beta of 0.64, meaning it is a lot less volatile than the market. Analysts do say it is a buy at $38 a share. Now this is a massive dividend payer, 5.67%, meaning you get paid $1.92 a share. They pay around about 30 billion dividend. And is this safe? Doesn't look too safe at the minute. 1,000% on the net income payout ratio and 220% on the free cash flow payout ratio. So currently it is not looking sustainable, but they have consistently paid their dividend. And if you want to get paid this, buy before the 21st of May later this year, and you'll get paid your quarterly dividend. So let's have a look at revenues. 195 million, decreasing over the last few years. Obviously, we all know what happened in 2020, and the stock dropped down massively, and then they've been able to rebounded very well in 22, but now you can see they have decreased to 195 billion. Now, if we do look at the stock chart over the last 5 years, I was saying it's a buy the entire time. It dropped down to 50. We'll have to go a little bit further out. Oh, we can't go that far out. You can see pre-2020, it was about $35 a share, dropped massively to its lowest, 56% down to $15 a share, and is up about 118% since then. But it has almost broke its pre-2020 highs, which was about $39, $35 a share. But you can see here that they have not got the revenue that they did pre the certain thing that happened in 2020 that you can't see on YouTube for some reason. Net income, are they profitable? Yes, 2.71 billion. But as we can see here, down from the prior year, which was 15 billion, which is the highest they'd had in many a year. Free cash flow is down 13.6 billion. If we look at operating cash flow versus capex, operating cash flow is down and capex is up, and free cash flow, obviously operating cash flow minus capex, and you can see it is decreasing here. So not looking too good on those fronts. Now, are they buying back shares? You can see there's been some splits here, but yes, they are buying back shares, rewarding shareholders, which is good to see. So let's have a look at the discounted free cash flow model. This is where valuing stocks looking at looking at their future free cash flows and discounting to today's value. Currently, it's giving us a share price of $12 a share. We'll change the weighted average cost of capital to that value here, $19 a share. Now let's have a look at these numbers and see if we agree. So we're still expecting positive growth in 25 and 26, 232 billion. Let's see if analysts agree. Oh, they've gone to night mode. Cool. No, declining revenues, 186 and 180. So we will go with declining revenues. We'll go a little bit less bearish. We'll go minus 4%. $11 a share. Net income margins, I think these numbers need to be changed. It's not negative. We'll go around about 4%. Okay, we're back in the minuses. Oh, because of the free cash flow rate. So let's just have a look what it was. Historically, free cash flow was about, jumping between 10 million. Yeah, I don't think it's going to like this, but let's see. So if it sort of was the 100%, it would be $13 a share. If it was able to match the 2023 numbers of 116, it would still not be a buy, $15 a share. So discounted free cash flow model does not like this stock. Let's have a look at the dividend discount model. Now they historically have grown about 10%. Obviously the weighted average cost of capital is much lower. So let's bring this down to about, we'll go 6%. Well, for them to be a buy, as long as they're growing at anything more than 1%, it is still a buy. So discounted free cash flow, Dividend discount model does like the stock. Ben Graham formed through intrinsic value. I don't think he's going to like this. So currently not buys on any front, which is quite interesting. BP has historically been a buy that I've been saying. 13.5% growth on the S&P 500. Over the S&P 500. $2 a share. So Ben Graham hates it as well. So finally, comparable company model. Let's see if this likes it. So this is the way of valuing stocks, looking at the competitors. We'll go with their biggest American rival, Exxon, ticker symbol XOM. And what this will do is it'll load all the latest company financial data for these other companies. We'll do Chevron, CVX. And we will do COP, which is ConocoPhillips. If you're interested in this sheet, check out my Patreon. It is the $4 tier. If you buy the $4 tier, you have access to the sheet and access to all its data. If you want the higher tier, that's $7 a month. And if you want the lower tier, just help me out at $1.50. But no one has done that. I don't want people to do that. It's just there because Patreon told me I need to do it. But yeah, I'd rather give you guys some value in the sheet. So we have the three compared companies to compare. BP is the smallest. There's the enterprise value. We'll look at the revenues, look at revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book peg. Second lowest revenue, negative revenue growth rate, which isn't good. Least profitable, smallest margins, price to sales looks quite low, price to book looks quite low. Market average, as you can see, is about 3 for this. They're all lower than 3, but it is lower than its competitors. Price to book value, market average is around about 5. It's lower than that. Price to earnings growth, though, ideally you want this under 1. 13, very, very high. EV to revenue, looking quite good. Lowest, but still $16 a share. EV to revenue, EV to revenue not good. Oh, sorry, I've lined this up wrong. EV to EBITDA, $16. EV to revenue, $16. EV to EBITDA, $8. Sorry. PE, $12. Ignore the fact that's green. Forward PE, not a buy. So not a buy on any front, which is quite interesting. Historically, this has been a buy and something I have been pushing, but discounted free cash flow model does not like it one bit. You can see here, despite its very low free cash flow rates, and because of this decline in revenue and things like that, it does not like it. It's expecting negative cash flow growth in the future. Oh, sorry, wrong one. Let me go to 2012 month. So even with even with these values here, you can see with the free cash flow being lower. If we increased it, I suppose, to kind of get the we got 13 billion in free cash flow. I'd say let's actually just go back to this and see if we would get a similar number. We've got 200%, 14 billion. These still declining over future years. So even more of a bullish case, it's still not a buy, $26 a share. Comparable company model hates it compared to these companies. Dividend discount model surprisingly likes it, and Ben Graham formula for intrinsic value hates it. So does not look a buy currently. I have liked the stock over the last few years, definitely over the last 5 years, since the certain thing happened in 2020, but recently does not look too much of a buy. Right, guys, thanks for watching. Please give a like on the video if you enjoyed. Subscribe if you're not already. Check out my Patreon. I'll catch you guys next time.